Welcome to another episode of the Profitable Home Services Podcast. I'm Diane Gardner, your host, and my guest today is Gretchen Roberts. And we're going to talk about numbers, but don't take off on us. I promise it'll be fun. You'll get good value from today's episode because I know numbers is not your favorite thing, but it is something that's so important for you to know and to understand so that you can have a highly profitable business, or you hear me say a lot, a wildly profitable business. So with that, welcome Gretchen.
Hi,
And
Diane.
tell our listeners just a little bit about who you are before we take off and roll.
All right, sounds great. Well, thanks for having me. I'm Gretchen Roberts. I'm CEO of Red Bike Advisors. We are a tax, accounting, and advisory firm. We're based in Wilmington, North Carolina. We serve clients all over the US. We have a ton of home services business clients, and I absolutely love working with you all because I'd say that your business is a little more fun than mine.
And it was funny because I picked them as my niche because my most favorite client was a roofer.
Ah,
He was
yeah.
a dream to work with. And then I had a few others that were in the home services as well. And we started thinking a long time ago, who's our favorite clients? And we tried a bunch of other niches and it's like, I don't like working with those people. And so we several years back, we settled on let's just go with who our favorite clients are. They're a lot of fun to work with. And I will say that compared to some of the other kinds of businesses, generally speaking, there's no ego involved. They
Mhm.
just truly want to learn. They want to learn how to run those businesses better, become more profitable, take home more money, those types of things, which you and I both agree on. They're a great group of guys to work with and gals to work with.
Yes, for sure.
Yeah.
I could not agree more. Yeah.
Yeah. So today we want to dig into financial statements a little bit. And I know that this is a topic that's scary for a lot of home service business owners. They're really great at whatever the trade is that they're doing. They came up through the ranks, and they decided they wanted their own company, but they're not real comfortable in understanding that profit and loss or that balance sheet or heaven forbid a cash flow statement. Those are scary types of documents that their accountants and their bookkeepers give to them. They file them away in a nice, safe spot, but they don't always do a lot with them because it's not comfortable. How can we make that a little more comfortable for them and show them some of the categories, some of the lines on that P&L that are super important?
Okay, that so first of all, that's a great question. I do want to say that this is not going to be a boring technical discussion. I am a business owner just like you all, and so I'm going to make this as interesting as possible for business owners versus let's make this a technical accounting discussion. So,
Yes.
with that said, I really think that the foundation, first of all, of knowing your numbers is what we call it, is having clean, up to date books. And a lot of, especially home service business owners that we know, it's really easy to get behind on that. And the reason is you're busy running a business, and maybe you don't have the time to either work on the books yourself or help the accountant or whoever is doing them for you. And so when you're not up to date, you don't get any information. That's the first piece is let's get clean, let's get up to date, and then we can use your books to tell stories about your operations and about your profit margin. And to your point, exponential profit is what we're going for. So, clean books are the foundation for that. Not checking your bank balance, which is how a lot of people manage their business, but looking at your numbers.
So, Gretchen, how can they understand when they have a clean set of books? Hey, I'm gonna play devil's advocate. I'm an electrician. I hired this bookkeeping firm. They said they can do a great job. I've given them access to my account so they can pull in my bank statements and credit card statements. I'm out here fixing a problem on some so and so's property, and I think they're doing everything okay. My guys are getting paid, but that's about all they know sometimes. How
Yeah.
can we give them some sort of a guideline to know if they've got a decent set of books? Because you and I see some terrible books out there. And we
Yes.
look at that and go, I can't even tell your story because these books are so bad. And I can't always say that to the owner. They've spent a lot of money on whoever their bookkeeper or their accountant is. And
Right.
then to tell them that these books are trash,
Yeah.
how can we give them some sort of little guidelines to look at?
So that's actually hard for an owner. It's like trying to understand how the sausage is made, right?
Mhm.
And a typical small business owner or home services business owner is not necessarily going to understand that. Sometimes it's getting a second set of eyes, having somebody look at it. For example, we'll do a thing we call under the hood. It's a little mechanical reference, but and we'll go in and go under the hood and we'll look at, are things being categorized on a regular basis? That's very baseline. Are all your accounts being reconciled? Payroll, credit card, bank statements, loan statements, all of those should be reconciled to avoid errors, fraud, all of that. Those are some baseline things. Is the balance sheet being updated? All of that. But again, most owners don't really understand that. I think the answer is you find somebody you trust to do your accounting, and you provide them what they need month to month so that they can deliver books to you, because I don't think most owners should be doing their own books, but I do
Oh.
believe very strongly that they should be responsible for their financials and for making operational decisions that come out of their financials. And that's really what we should be talking about, because that's the most important thing. I mean, you do have to have that foundation, but once you feel confident in that, now you have opportunity. And that's what we're talking about, right?
Yes.
Yeah.
Yes. Yeah. We just had to lay that little bit of a foundation in there
Yes.
first. Um, I know I've come across guys that are using CRMs, whether it's Service Titan, House Call Pro, one of those. They're using that. And the number from the CRM is a completely different planet than what's in their QuickBooks file.
Yes.
And they don't know why. So coming up with some sort of a base to start with so that we can start helping them learn and understand those numbers so that they
Yes.
can make good decisions and they're
Yes.
not shooting from the hip type of thing based on what's in their bank account or based on whatever the hottest fire is.
Yes. Absolutely. Dumpster fires versus trash can fires. But here we're talking about being proactive, right?
Yes.
So yeah, so let's assume you have the foundation, you feel like your books are clean, up to date, you have a lot of confidence in your accountant, and your bookkeeper. And so what the numbers actually do, and this is where the profit hides in them, is they actually are telling you almost everything you need to know to make pricing adjustments, to make operational adjustments, to make marketing and sales adjustments to improve your profit, which is ultimately the goal. We want to grow the business, keep it sustainable, but also improve the profit.
And but the only way we can improve the profit is if we know what profit is.
Right.
And we set some goals and profits at
Yeah.
whatever percentage today, and we want to get to this percentage tomorrow or next month or whatever it might be, having something to measure off of and looking at those numbers on a regular basis,
Yes.
not just once or twice a year.
No, I think business owners should be reviewing their financials monthly. And here's what happens is if you start looking at your financials, it's just like anything. You're not good at it. You're not good at it yet. But what happens is when you start looking at it month over month over month, you start seeing patterns. Once you start seeing patterns, you can start asking the right questions. Once you ask the right questions, you can make changes in your business. So the way I think about it, and let's start with profit because you're a profit first shop and you're all profit first. Um, so the way I think is profit first, there's a very specific methodology. From a P&L and balance sheet perspective, I think about it a little bit differently. I think of it in terms of buckets, like expense ratios, right?
Uh-huh.
So if you think about, let's say there's four buckets. And so the main bucket is revenue, and revenue is always going to add up to 100%. And then underneath revenue is what's coming out of the revenue. So you've got three big buckets. You've got cost of goods sold, you've got operating expenses, and then you have your profit. Okay. And so the first thing you want to do is you want to roll up all your expenses into those categories, and then you can benchmark against your industry and see where you're at. And this is how you know what levers to pull in the business. Because if you find out, if you just look at your P&L and L and you're like, oh, my profit margin is only 10% and that's way below industry standard, you go, now what do I do? And you're not sure what lever to pull. But by
Right.
using those other buckets, okay, let's look at cost of goods. Is that is that a good number compared to the industry, or is that sky high? Is it your operating expenses that are sky high? What's going on? What's the story here that is causing my net profit to be so low?
And if you guys just realize, she just said, what's the story? Because these financial statements tell a story about your business. They tell you you're if I'm trying to think of an easy way of not getting too nerdy on the accounting side of it, they tell you if you're handling your money in a good way or maybe a not so good way, because all that money flows through your fingers and it's up to you to keep a certain percentage of it so that you can pay yourself and that you can take your profits and you can do those things and not just barely make it 1 week after the next after the next. We don't want
Yes.
anybody living at that, you know, just barely survival mode. We want you to be healthy and profitable. I know one of the areas when I'm working with home service business owners is they get confused between what belongs in cost of goods sold and what's an overhead expense. And I see people with cost of goods sold at 15 or 20%. And I know it's like, oh, wait a minute, we got to go looking down in the overhead. There's more expenses that need to get put up there.
Yeah.
What's a quick, easy way that we can share with them on how to know when something is a cost of goods sold versus when it's an overhead expense?
That's a great question. And I'd actually start by saying why it matters. And the reason it matters again is if you go back to where are my profit leaks, if your cost of goods is 15%, but the industry standard is 50%, and there's some variability between different home services categories, but let's just call it 50% as a benchmark. You don't have things in the right category, right? And the reason that matters is because now you don't really understand what it costs to deliver the service and the products that you sell. And that is the number one lever to increase profitability. So that's why it matters. What we see often when we have new electric companies, plumbing companies, HVAC, landscaping companies, when they come to us, typically what we see is they'll throw a couple of um, you know of let's call it like tools or something like that into the cost of goods. But often they'll have all of their payroll,
All day, yes.
including the service providers, lumped into operating expense. That's probably the biggest one is you really need to separate your payrolls. You need one payroll line item in cost of goods. That's for everybody who delivers the service you provide. And then you have another payroll line item under operating expense for admin. And then you may also actually break out sales and marketing payroll if you have that on your staff as well. And that way you can track those expense ratios across all of those areas. So payroll is probably the biggest one. The other ones I see a lot are tools, trucks, equipment rentals, uniforms, like really anything. The way cost of goods should work is anything that you need to purchase to deliver your product or service to the customer should go in cost of goods. And that's how you get a good benchmark. So what we do is then we do a whole chart of accounts, reorg, and then we can do that benchmark. And often we'll see it like, now we've done it and it's coming out at like 60%, way too high. And so now we know that's the lever we can work on.
Okay. And when we're looking at that cost of goods sold percentage, if it's 15 or if it's 60, we know that there's potentially a lot of work that can be done in that area. You can go back to looking at your pricing. It could be the amount of time it's taking to get these jobs done. Do we have too much overtime? Do we have too many callbacks? Do we have too many oftentimes the materials aren't ordered correctly on jobs, and so we got slush sitting out there and extra materials. So there's so many different ways that we can dig in and help you pull that cost of goods sold into a more respectable number so then you can see what kind of a profit are you really making on your jobs overall. Now that
Yes.
doesn't tell you job by job by job, but it will tell you in overall numbers how are you doing on your profit on your jobs. And that's why that number is probably the most important number I think on the whole P&L is that
Mhm.
cost of goods sold number.
Yep. I could not agree more because as your business is growing, your cost of goods typically will increase around the same percentage, right? But on the other hand, operational expenses shouldn't increase as high. You should be able to get some leverage from operational expenses. Not they won't stay the same, but they won't rise at the same percentage level as cost of goods. And so that's why that's the biggest lever for increasing your profit is looking really closely there. You mentioned a couple things there. I would add to sometimes we will see it actually too low even after we've moved everything around and it's really the cost of goods is really low and often we see that for a couple of reasons. One is that you're underpaying or overworking your team. That's
Yes.
one of them. And
Yep.
another one is that the owner is working in the business and not accounting for it properly. And so it looks like your cost of goods are really low, but you're not paying yourself a payroll salary, or maybe you're paying yourself a small salary if you're an S corporation, and you're not really adding back what it would cost to hire somebody to do the job you're doing as the owner slash technician.
Now I'm going to go a little deeper with that thought about the owner is oftentimes I see owners wearing so many multiple hats that a portion of their time they're back in the truck.
Yes.
Even though they don't want to be, they're back in the truck. And so we need to take a look at your overall salary or pay and break that out to that in the truck time is separate from your management and your CEO time. And then that helps does make a difference on that cost of goods sold number. That is what I see constantly, that not breaking
Yeah.
out that owner salary.
Yes. And sometimes it has to do with tax reasons, right? So, for
Yes.
example, if you're an S corporation, which a lot of these types of businesses are, you have to pay yourself a reasonable salary, but you want it to be as low as possible. We'll do a documented salary analysis for that to see what the owner really does all day. But you want it to be lower so you can lower your payroll taxes and take the rest in distributions. But if you're paying yourself, let's say 50 grand, but if you had to hire and you're spending half your time, in the truck, and if you had to hire somebody to do that job for you, what would you have to pay them?
Right.
Is it 60 grand? So, you're not allocating that whole salary properly or what it would cost to hire somebody. I will say we have a thing we do with owners. It's really fun. It's called the Profit Time Index. And I got that from a mastermind I'm in. And it's basically a measurement of how much time you spend working in your business versus how much profit you have. And so,
Very eye-opening
oh,
exercise, isn't
it
it?
is. It's so
When you do
fun.
it.
And the goal is to see it grow because, you can see where you're stuck when you're in there working in the weeds too much and you need to get out of the weeds. It's a hard transition to make, but once you see those numbers, they don't lie.
They don't lie, yes. And it really gives you a reason to make a change
Yes.
when you look at that number.
And that
Yes.
change, I will say, that change is hard because there's a temporary reduction in cash when you hire somebody to replace you in the field.
Mhm.
And that's a reduction in profit because you're making an investment. But the goal there is that you reposition your time so you're focused on growing the business, on sales and marketing, on making operations more streamlined, all of that. And so, when you replace yourself, you don't just get into a different set of weeds, but you start working on the business instead of in it.
And I say sometimes I think that takes a big mindset shift. They're comfortable in the truck. We've been in the truck for several years. And to actually pull out of the truck and move over and put on the CEO hat and keep on the CEO hat, it's easy to put it on and take it off, put it back
Yeah.
on and take it off. But to actually keep it on and stay over there, that's a huge mindset shift. Because I hear them say, but if I just go out and fix this, it's done. I can do it in so many minutes or whatever. But that's not a long-term fix and it's not scalable.
It's not. And I will say, some business owners, they're perfectly comfortable running a business where they are the business essentially
Mhm.
with some employees, right? And if that's what you want for a lifestyle, that's totally fine. But if you ever want to exit, there's a phrase. It's I, the owner, am the bottleneck, and I'm at the top, and the bottleneck is very narrow, right? And if you want to get out of that, and if you want to be able to sell someday, if you want to have real time freedom, you have to go through that slog and that, to your point, mindset shift of getting past being a a producer into becoming let's call it a creator, right? The
Yeah.
manager, the strategic head of your business that's focused on growth rather than on doing the production work.
And I'm going to echo what you said earlier because I can hear them sitting back here going, but I'm not good at that. And then you added the word yet.
Yet,
I'm not good at that. It's not comfortable. This is not where my strengths lie. Well, I'm going to say Gretchen and I didn't start out being good at that either. We
no,
started out in the books, heads down, doing the work, and have had to work our way to where we've developed our professional skills so that we can run these companies. And you can do it too, because we're no different than you are. We're both running small businesses just like you are, and you can do it. And you just, here it comes with that mindset shift. I'm not good at that yet, but I will be.
yep.
And just
And
keep
the other thing
working on
too
it.
is if you're not good at it yet and you feel like you never will be. So an example, maybe I think a good example would be doing your own books or doing your own marketing. You don't have to do that. You just need to find the
Right.
right people to do it for you that are good at it. And then you supervise them.
And then you reap the benefit of their knowledge.
Yes,
Yes,
exactly.
because
Yep.
we are all gifted in different areas. Some of us are great at doing like that marketing and stuff. Coming from the accounting background, I've had to learn marketing, and it was really hard, especially at first, because I wanted to be this nice little introvert, hang out in my corner and just do work for clients. And I've had to learn how to be that front-facing face of the company, and it was not easy. It was painful.
Yeah.
And I'm sure you can probably say the same type of thing. So, we've done it. We have faith that you guys can do it too. And it won't be easy, but you can do it. And you can develop those skills so that you are the CEO and even the CFO of your company over
Yes.
time. But fill out your team. And your team may not be just people who work in your office. We have financial teams, we have legal teams, we have HR teams, we have marketing teams. We have all these people that become part of our team that almost acts like our board of directors, like a big company would have,
Yep.
because they give us input and insight and help us become more profitable because they each have their areas of expertise.
Yes. And you can get it for a fraction of the cost, which is why it's called fractional.
Yes.
Yes.
Yes. So, Gretchen, what's some other areas on a P&L that they should be thinking about? We've kind of talked cost of goods. What
Mhm.
about down in the overhead area?
Yeah. Okay. So I would divide, so on the P&L, all your operating expenses are all lumped together, but I would divide them between operating expenses and then sales and marketing expenses.
Mhm.
And there's a reason for that. So let's talk about operating expenses first. So a lot of those costs are fixed, things like rent, monthly bookkeeping services, payroll software, just different fixed expenses that you have. Some of them are variable, like utilities and things, but again, they should not grow at the same rate as your cost of goods as you're scaling the business. You should be able to realize some efficiencies on the OpEx side with scale, and that would be things like base software prices, facilities to a point. I mean, there may come a point where you actually outgrow where you're at, but for like as long as you're in a building that can hold all the people and the equipment and things, then you should be able to hold that at a fixed cost. Insurance, again, to a point, it'll incrementally increase. Professional services to a point. But the point is, those costs shouldn't be growing as quickly as your cost of goods matches your sales. So that's one area. And then and I would say there, one of the little things exercises that we like to do with clients, it's called a quarterly expense buster. And it's fun. See, I told you this number stuff would
Trust
be
us.
fun.
Trust us. It's fun.
So yeah, it's fun. No, you have your account or you print out every expense that was made through the quarter. You take off things that are fixed, like rent and cost of software and things that you can't really do anything about. And you highlight anything that looks odd or that somebody just charged on the credit card and you have no idea what it is. Um, expenses that you feel like potentially could be renegotiated with the vendor or repriced out, or even, in terms of technology, not that you want to just change technology like you change your underwear, but there are times when you do want to make a strategic technology move as it changes so fast. And so that quarterly expense buster actually puts a microscope on all of your expenses that you don't even know are going through, because there's so many transactions and you as the owner can't be expected to keep up with all those every week, every month. Again, you're trying to look at the high level. You're looking at the overall numbers. What is my revenue? What is my gross profit? What is my net profit? But this gives you a chance to hold your team accountable, especially if they have charge cards, to make sure that the expenses they are expensing are valid, that they contribute to somehow to either growing the business. There's some kind of investment, or this is what I tell my team too is, do you have a business case for that? If you have a business case for it, then go for it. If you can prove that it's going to help generate revenue, profit, delight customers, whatever it is, then that's fine. But what we find is when we go through this exercise with clients is, there's a lot of stuff that is being charged that the owner has no idea about and has no relevance to the business. And if you can wipe that stuff out, guess what? That number goes directly to your bottom line.
Yeah. When we do that exercise, we have three highlighters. We have a green highlighter, a yellow highlighter, and a red highlighter.
Nice.
So green is good to go. Yep, we need these things that they allow the business to do whatever. Yellow is we need to maybe dig a little deeper.
Yep.
You're not quite sure where we're going with this, how, who approved it, type of something like that. Red is blatant, or your pink highlighter, you know,
Yeah.
like, oh, I think we can stop this one now. And it's pretty interesting to color code that list when you print it out. And their eyes get kind of big. It's like, whoa, there's a lot of yellow and pink sitting out here. We need to
Yeah.
go check these out. And so it makes a
Yeah.
great visual when you
It
have the
does.
three colors like that.
And again, literally right to your bottom line when you cut those
Yes.
out. So, it pays to look at your expenses every quarter.
Yes, especially when you have team members with credit cards.
Yes.
Yeah,
Yes.
because boy, it can get out of balance. I had a client, oh, probably 2 years ago now. It was a towing company, and we were going through their stuff, and their guys all had fuel cards. And so, to begin with, we were just getting the printout from the company and booking it to fuel. Well, numbers had been off a little bit. And we weren't sure why. So I had to drill down into that and actually look at the receipts behind the reports that she got from her fuel company. And there was cigarettes, there was tobacco, there was soft drinks, there was beer, there was chips, there was all kinds of stuff going on there.
Yeah.
And when we dug into that over the course of about a quarter, there was about $10,000
Yeah. That gets
just
expensive
in
very
stuff.
fast.
Yes.
And even just doing the exercise in front of your team tells them that they are accountable and
And
that
we're
you want the
watching.
team. Yep.
Yeah, we
Yep.
care. Yeah.
Yeah. And those things seem little, right? But this can actually, this is an example of how your books can be perfectly reconciled and everything categorized correctly, but there are still things slipping through the cracks.
Hmm.
And it's not, I mean, I wouldn't call this fraud necessarily. It's just probably misuse of funds, or,
Yeah.
using the credit card without specific permission for those specific items. And it's easy to let that kind of thing slip by unless you're paying attention.
Yeah. In her case, she reached out to the place where they always filled up and said that the only thing that was allowed on the card was fuel
Yeah,
after
that's
they
great.
had a meeting with their employees. And it was amazing how that bill dropped every month.
Amazing.
It was amazing. And all that went straight to their bottom line profit. But it was a leak we didn't even know that was there. I'm sure it had been there for years until somebody got a little too aggressive with it.
Yep.
And that's what caught the attention is all of a sudden, we laid out the 12-month, P&L where the months are lined up next to each other. And we watched that line starting to grow. But our sales haven't grown that much. Why
Mhm.
is the fuel cost going up?
Yes.
Okay, yes, prices have gone up a little bit, but why are fuel costs going up? And that's how we found it
That's a great
was,
example. That is a
yeah.
great example. Hmm. Yeah.
And about $10,000, $12,000 a quarter that added back to profits.
Hmm.
And
Think what you can
that's
do with
fun.
all
So
that.
yeah, that's more than somebody's salary for a year.
Hmm. For
by
sure.
just plugging that one leak.
Yep.
So we were pretty happy when we found that one. Profit leaks hide everywhere.
Yes.
There. And those of you who've listened to this podcast for a while know that you always hear me say there is no place on your P&L that has this magic strobe light going profit leak here, profit leak here. You have to dig in and you have to go looking for them because they're there and they're hiding, and you have to discover where they are and then get that leak plugged and don't let it come back on your books because it's easy 6 months or a year from now to find that same profit leak again
Mhm.
because we thought we had it fixed until we didn't.
Yes. And that's why I think there are, certain things you should operationalize. That's one of my favorite words, So for example, looking at your expenses every quarter is a good example of that because, nature, entropy, the concept of, in nature, I think it's a chemical concept, but you get everything cleaned up and it doesn't stay clean. It just sort of
Stay.
unravels itself again. And so, once you determine what those key things are for you that you need to monitor on a regular basis, just put it in your calendar, and make sure you're looking at them on a regular basis. So that's a great example of that.
Yeah. And there's so many other places that we can find leaks on a P&L statement. Um,
Yep.
and then
And
there's
it's not
leaks.
just
Mhm.
expenses either.
No.
I mean, we could talk about revenue. We didn't really talk much about revenue, but you can see it in revenue too. The revenue bucket is 100%, but where is the revenue coming from? And do you have it segmented by like product or service line or geography or whatever? And then once you figure out how to separate that out, like for example, we had an electric services company come in and they have new owners. They had just bought the the business, and the previous owner was just lumping all the revenue into one line.
Mhm.
And so we talked about it, and we talked about best practices, and we ended up separating it into to product because they were selling generators, into service, time and materials, just regular ongoing work, and then they also did these sort of one-off projects for new construction, and so we separated that out as well. Now you can do some of this in your your job software as well, and we could get into a whole discussion around profitability per job, but and then the fourth one is maintenance
Mhm.
because once you see where all the revenue is coming from, that's a starting point, right? But then you want to actually go deeper if you can. If you have let's say maintenance as an example. So um, you have a specific maintenance crew. That's what they do if it's a big enough of a service area. So you can measure profitability by maintenance. But these are all dials and levers too, because one of the other things that I like to think about, just going back to sales and marketing, is so sales and marketing, it's a portion of your operating expense. Typically, it should be somewhere between 8 and 12% of revenue, maybe higher if you're growing really fast, um, and maybe lower if you sell something that is a repeatable service. But you know, if you think about something like maintenance contracts as an example, that's a perfect place where you can increase your customer lifetime value, because you sell them the big one-off job and then you cross-sell or upsell them the maintenance work. And as soon as you do that, however much it costs you to acquire that customer, have this ongoing work. And it may be small, but those annuities, if you do it with every single customer, and even if you close half of them, you're building up a whole annuity business in addition to your one-off jobs, and that lowers your cost of marketing. So that's another example of a profit leak, is basically focusing all your marketing spend on one-off jobs and then not bothering to do the follow-up with the cross-sell and upsell with maintenance or any kind of an annuity that then lowers your cost of marketing.
I'm going to circle back around to the revenue piece. I see a lot of companies that have become more in the title of their company is more, they'll use the word services or home services or something. They may have started out as a plumbing company or an HVAC or an electrical, but now they've added other lines of service. A
Mhm.
plumbing company that's now offering HVAC and electrical, or an electrical company that's now offering whatever. But
Yep.
if they throw everything in one pot, they don't know which service line is profitable and which one isn't. Had a
Yes.
client who did that and they blossomed out to like four different lines of service. And when we finally got them to break things out by service line, one of their lines of service was eating the profit of two or three of the other lines of service. And he
Yes.
kept saying, "Oh, it'll get better. It'll get better." And we watched it for about a year. And finally, the light bulb went on and he closed off that line of service. But he didn't realize that it was eating up so much of his profits in that one line of service because they, it just was not working for them. They needed to stay with the ones that they were really good at.
Yeah. Yeah.
But
That's
until we broke it out, he had no way of knowing.
that's a perfect example. And you say it's hiding in there, and there it was, hiding in plain sight.
Hiding. Yes, hiding
Just
in plain sight. Yeah.
yeah, the numbers just needed to be broken out to be able to understand that. And of course, you have to follow through too. And sometimes it's not possible because let's say your team works on everything, and so it's really hard to allocate the
Hard.
cost of goods across service lines. But if there are discrete ways of doing it, you should,
And
because these are the kinds of things you find.
yeah, some of the CRMs are pretty good at giving us numbers that we can then put into their QuickBooks
Mhm.
and break out some of the service line costs as well as their revenue.
Yes.
And that's been helpful, as we've moved from a manual to more of a digital type world in the home services industry. We can get more information from some of the CRMs. And
Yes.
that's allowed us to be able to look at these different service lines and figure out, are they all profitable?
Hmm.
Because if not, that can be super expensive for you.
Yes. And sometimes, to your point on your client's story, the answer was to kill it off because it just wasn't in their core competencies. But other times, it's a question of, well, what would it take to make this profitable? And then we have to look at like there are some levers to look at. You want to look at your pricing. Are you priced correctly? Are you priced according to the market? Another one to look at is, are you operating efficiently? With the team. And those are probably the two biggest ones. But if you can move either or both of those, you could take a department and go from vastly unprofitable to wildly profitable if you could move those levers. And by the way, here's my little. I'm going to get on my soapbox about pricing for a moment because I'm always saying, when was the last time you increased your prices? And it's been like 5 or 6 years. Business owners should be increasing their prices every year. My coach actually says it should be done 20% per year, and he's got this whole formula as to why, which has to do with inflation, ballooning healthcare costs, like all the things that go into running your business.
Mhm.
And that's the minimum it would actually take to maintain your profit at the rate of inflation. Now, that probably gives most business owners heart palpitations.
I would think so.
Yeah. So, but not raising it all actually has a compounding negative effect because your expenses are still going up. Believe me, everything on your operating expenses and your cost of goods is increasing. You're probably giving your employees raises, even if they're just inflationary. Health insurance is going up if you offer that. Everything on your P&L is going up except some fixed costs like a lease. Your insurance is going up, like literally everything goes up every year. And so if you're not raising your prices, that is a huge profit drain by not doing it. And yes, it's scary, but yes, it's necessary.
Yes. Yes. And when you do, it will drop to your bottom line profit. You didn't have to
Yep.
sell more to get it. You just had to get brave enough to
Yeah.
put your new pricing out there. Yeah,
And that is definitely head trash
it is.
slash mindset, talking about mindset earlier. It is scary to raise prices and you're afraid that you're going to lose clients and all that. But what really happens is they understand you're running a business and 95% of them don't say or do anything. And the other 5% that complain were probably the people you didn't want anyway because of the nickels and dimers. The other thing about that is, and a lot of times, you either have ongoing projects or you work with the same, businesses over and over again or whatever. And so you're afraid that they're going to leave you. But a lot of times, even if you were reluctant to do that, even if you just raise your prices for new people coming in the door, that's something. I mean,
Something, yes.
not raising new prices for new people coming in the door is a huge profit buster. Huge.
And
They
it's a
don't know what
good
your
place.
prices were
Yeah.
before. It's a good
Yep.
place to
Good,
start.
good place to start. Yes. Yes. And then you can roll out a price increase to everybody else. But
Yes.
yeah. Wow. This has been really good. Thank you, Gretchen. Um, one last item that you can think of that or a place we can tell them to go look for a profit leak.
Um, yeah. So I'm going to say something that's actually not on the P&L on the net
Okay.
profit line. Okay. I'm going to talk about below the profit line. So
Okay.
there are expenses that come out after net profit that owners usually don't understand. And every time I get a call from someone and they say, why does my net profit say it's 500,000, but I only have 200,000 in the bank or
In
whatever
the
it
bank.
is?
Yes.
That's always the question. And the reason for that is there are usually four big expenses that come out below the bottom line, as I like to say. And so, one might be loan principal. So if you have a truck loan or if you have a business loan, that interest, let's say it's a $5,000 a month payment, and let's say half of that is interest and half is principal, the interest payment is deductible on your profit and loss as a business expense. And so you'll see that on there. But what you don't see is that the principal is being applied to pay down the loan on your balance sheet. And so that cash is coming out, but it's not showing up on your P&L. And so, over the course of a year, that's a big chunk of money that just feels like it just went away. That's a big one.
A
Taxes are
big one.
another one. This is kind of a bigger discussion in terms of entity structure and everything else. But, Mike McAllowitz says in Profit First that, the business should be able to support its own taxes, even if you're paying for them personally as a pass-through entity. So that needs to be allocated below the bottom line. Another one is cash savings. So, at least a month's worth of expenses and in an operating account, but we like to see 3 to 6 months in a
Yes.
savings account, money market account that's earning interest. And that covers, a lot of these businesses are cyclical or seasonal. There's a lot of seasonality in home services. And so that covers those slow months. Um, and then reinvestments is another one. So this typically a reinvestment will end up on your P&L. Like if you make a new hire, you hire a crew, you buy a truck, something like that. But they do need to be accounted for once you understand where your profit is, because you do have to watch your cash flow, right? And so we talk about profit leaks. I don't think it's a real profit leak. It's just one that feels like a profit leak because those are things you're not accounting for. If your bottom line says you made $500,000 this year, you're like, where the heck did all of that go? Well, just look through that list, and that's probably where a lot of it went.
Yeah, thank you for clarifying that because that's a question I get constantly as well. It's
Yeah.
like, how come my bank account doesn't reflect my
Yes.
my supposedly net profit? Why am I paying tax on all this money when I don't have it sitting in the bank?
Yes.
Yeah. Long, long time ago, I worked with a business that had the idea in their head that whatever that net profit number was at the end of the year, they had to go spend that much money so they wouldn't pay any tax. It's like, no, because it killed their operating budget for the next 2 or 3 months because they ran out and spent that money at the end of the year. It's like, please don't do that. That's not good tax planning. So,
We call that letting the tax tail wag the dog.
yes.
And I always say, like, my rule of thumb here is this expense that you're proposing to make, is it going to create revenue, profit, or delight clients or customers? If you're just buying a new truck because you want a new truck or because whatever, because your tax guy said to, you're doing it wrong. You should only buy a new piece of equipment or hire a new person if it's an investment that's going to produce ROI for the
Right.
business. It's going to help you grow in some way. And otherwise, just be happy to pay Uncle Sam because you made a lot of good money this year.
Yes. 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 Well, Gretchen, we've come to the point in the program where we have our magic question. And our magic question for any new listeners out there is what is a hidden or unique profit leak that you see when you work with home service businesses?
Um, yeah, I mean, there's a lot of them. We've talked through a lot of these.
Mhm.
I think probably one of the biggest ones I see is in so we're going to go back to cost of goods sold because that is the biggest lever for profitability, right? And I'm going to go back to buying things that you don't really need. Okay. So
Okay.
we were talking before about the expense buster, in operating expenses. But if we go into cost of goods, a lot of times your crew, so, a lot of them have credit cards and they're buying things. They either are or aren't allocated to a job, but nobody's tracking it properly. And
Oh, I like that.
and just having a microscope on that over time can add up to a lot of money. And so, when you look at the big levers for reducing your cost of goods, it's being more efficient and raising your pricing. But then this is a little one. It seems little. It seems insignificant, but like just like your story with the gas station and they're buying cigarettes and candy on the company gas card, that stuff can add up to a lot over time. And it's interesting. I'm trying to remember what the stat is, but it's something like if you can increase your gross profit just by 5%, um, at that top line profit, that can add up to like something like 30 to 50% extra on your bottom line. Don't ask
It
me how
does.
that
Yes,
math works, but it does.
it
So,
does. It's a compounding something that works. It's
yes, it
amazing when
does.
you see it
Yeah.
happen.
And
Yeah.
so if I were going to say focus anywhere at first, I would make sure that you understand your actual cost of goods, you have everything in that right bucket, and then I would drill down there to see how you can exponentially increase your net profit by uncovering some of those even tiny little expenses that could add up to big bucks on the net profit.
Right. Well, thank you. Yes, in my coaching group recently, we've been working on the power of tiny gains. And
Oh,
that's one of those tiny gains. It feels like insignificant, but boy, over the course of a year or over 5 years, it's a big number. And
yes,
there's a lot of those types of things that feel small, but they're not over time. And the
for
power of
sure.
tiny gains can really add up to be a big number when you
Yeah.
actually add them all together. So,
That's the opposite. I love that. The power of tiny gains. It's like the opposite of death by a thousand cuts.
yeah. Yeah. And we can, it's easy for us to say, okay, let's go fix this one small area. Okay, now let's go find another area because they're busy. They're running like crazy, putting out fires, taking care of their customers, their team. And if we lay something heavy on them, good chance it won't get done because they're busy. But we can
Yeah.
take these small items and hit those and get some immediate cash relief coming in.
Yes, for
So
sure.
great places to start. You get
Yeah.
some quick wins. So
Yeah.
yeah,
Quick one.
thank you again, Gretchen. This has been amazing. Listeners, I hope you've enjoyed it. We tried not to use a lot of accounting terms. I think we did a pretty good job. We didn't nerd out too much on you. I'm hoping that you found some real value in this episode. And if you did, would you please like and subscribe and whatever platform that you're listening to this, or if you're viewing it on YouTube? We appreciate it so much. Leave a great review, all those types of things to help us continue to grow this platform, grow this podcast, so we can continue to bring you more profit saving ideas. And with that, Gretchen, how can they reach out and find out more about you and your firm?
Yeah, we're at redbikeadvisors.com. So you can find us there. Most of you probably aren't on LinkedIn, but you can look me up on there as well if you want. I'm at Gretchen Roberts.
All right. Thank you again so much. And listeners, if you are wondering if you've got or how many profit leaks you might have in your business, be sure and download our 15 profit leak guide. I'm sure you're going to find some of them from that list that you can quickly plug in your own business and reach out to either one of us. We'd both love to help you and help you become wildly profitable and stop living from just week to week, because that is no way to go for very long in a business. That's painful. So, thank you again for joining us for this episode. Once again, I'm Diane Gardner, your host, and thank you. We'll catch you on the next one. Bye bye.
Bye.